One fascinating aspect of the financial world is the concept of behavioral finance. This field blends psychology with economics to explain why people often make irrational financial decisions. Here are a few key points about behavioral finance. Heuristics and bias. People use mental shortcuts, known as heuristics, to make complex decisions more manageable. However, these shortcuts often lead to biases. For example, the anchoring bias occurs when people rely too heavily on the first piece of information they receive, the anchor, when making decisions. Prospect theory, developed by Daniel Kahneman and Amos Tversky, prospect theory suggests that people value gains and losses differently. Essentially, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. This can lead to risk-averse behavior, particularly in the face of potential losses. Herding behavior. This is the tendency for individuals to mimic the actions of a larger group, whether those actions are rational or irrational. In financial markets, this can lead to asset bubbles or crashes. For instance, the dot-com bubble of the late 1990s was partially fueled by herding behavior. Market sentiment. The overall mood or attitude of investors can greatly influence market movements. This sentiment isn't always based on fundamentals, like company earnings, but can be driven by news, rumors, or even social media trends. Framing a fact. The way information is presented can significantly impact decisions. For example, investors might react differently to a 200-point drop in the stock market compared to a 2% decline, even though they may be the same thing. Understanding these psychological factors can help investors make more informed, rational decisions and avoid common pitfalls in the financial world.